This episode is brought to you by Alibaba.com, the world's leading B2B e-commerce marketplace. They'll help your business stay competitive and discover new, innovative, and affordable products from over 200,000 suppliers and manufacturers worldwide. And with their trade assurance, you can shop with peace of mind. No more worrying about international payments, delayed shipments, and convoluted refund policies. Even customized orders receive protection. The world of business is waiting for you. Visit Alibaba.com.
This episode is brought to you by Huel. Between hitting work deadlines and exercising, eating healthy food feels difficult. Thankfully, Huel Black Edition has your back. Each 400-calorie meal contains a scientifically calibrated mix of 40 grams of premium plant protein, carbs, fats, fiber, and 27 essential vitamins and minerals. It comes in 9 flavors and costs $2.50 per meal. All you have to do is shake. To get a free t-shirt and shaker and free delivery, go to Huel.com/US.
This is Optimal Finance Daily, episode 2340, Making Your Own Stock Dividends by Chris Reining of chrisreining.com. And I'm your host and personal finance enthusiast, Diana Merriam. This show is actually one of multiple shows in our network covering different topics like personal development, health, and relationships. So if you like narration-style podcasts, be sure to search for Optimal Living Daily wherever you're hearing this, and check out our other shows. But for now, let's get right to today's Monday Mastery post as we optimize your life. Making Your Own Stock Dividends by Chris Reining of chrisreining.com. I started questioning my entire investment strategy. I had built a stock portfolio for growth and was sure it was a horrible mistake. I had already quit my day job to live off stocks, but was only getting $3,798 in dividends. That's the reason retirees love income portfolios. They invest their nest egg in things that generate enough income to fund their retirement. Typically stocks like AT&T or Coca-Cola or whatever pays a fat dividend. So I considered switching my portfolio from growth to income. It certainly would make life simpler, getting those quarterly paychecks. But it'd also be an expensive undertaking. I'd need to pay the capital gains tax. And then a funny thing happened. The more I thought about it, the more I realized something important. I don't want dividends. The reason I invest in a business is pretty simple. I think the business can grow. And if the business grows, the stock price should move in unison. How exactly do businesses grow? Well, they can acquire another company, like Amazon buying Whole Foods, create a new product line like the Apple iPod, iPhone, iPad, watch, or expand their territory, Netflix from the US to 190 countries. These bets on growth don't always pan out. For instance, Amazon's Fire phone was a $170 million flop. But management only needs to be right more often than wrong for the winning bets to overshadow the losing ones. And that's why I don't want dividends. I want management to smartly reinvest 100% of earnings into growing the business and improving the earnings and widening the moat rather than paying me a dividend. Granted, sometimes earnings can't be efficiently deployed, hence stock buybacks and dividends. Maybe an example would help. Okay, pretend you and I own a lemonade stand that's worth $10,000. The stand earns 10% per year or $1,000. We can earn the same 10% on any earnings we reinvest. There are also some kids in our neighborhood who would love to buy into our stand. Why work at the stand when the stand can work for you? These kids are willing to pay 125% what the stand is worth. Projected future earnings. So the market value of our 50% ownership stake is $6,250. I'm thinking the stand should pay each of us 25% of earnings. The remaining 75% will reinvest into growing. Sound good? So in the first year, the stand earns $1,000. We each get a dividend of $125. The stand keeps and reinvests $750. In 10 years' time, the stand will be worth $20,610, and we'll each be getting a $258 dividend. But here's the question. What if we had decided to reinvest 100% of the earnings? We'll lose our $125 dividend, but remember, we can sell part of our ownership stake to those kids. And if we each sell just 2%, it creates the same initial $125 quote unquote dividend. Are you still with me? After 10 years, the stand will be worth $25,973. But since we've been selling 2% of our stand every year, we now own just 40.85%. That's bad, right? Well, in the first scenario, we each collected $2,026 in dividends, and our 50% ownership stake is valued at $12,881. That totals $14,907. In that second scenario, we sold 2% of our ownership stake each year and collected $2,059 in quote unquote dividends. And our stake is valued at $13,244. That totals $15,303. So making your own dividends was better. We got more cash to spend, plus our ownership stake is worth more, even though we own less. I hope that exercise wasn't too painful, but I think it's helpful to show what can happen when 100% of earnings are reinvested into a business. And really, our lemonade stand isn't that much different than a business in the S&P 500. Here, the argument grows stronger because the S&P 500 earns way more than 10% per year and sells at prices higher than 125%. All this doesn't change the fact that retirees love income portfolios. My guess is that it's mostly psychological, that when you get a dividend, you never feel bad about spending it because you never touch your principal. And then you insist that every stock you own pay a dividend because a stock that doesn't pay a dividend means less money to spend. On the other hand, selling shares to make your own dividend means making decisions. What stock do I sell? What if the market is down? When should I sell? What if the stock goes up? It's very easy to make a regrettable decision. So, dividends. But I'm not trying to convince anyone who's building an income portfolio to abandon their strategy. I'm just telling you why dividends are a small part of my investing and why. You just listened to the post titled Making Your Own Stock Dividends by Chris Reining of chrisreining.com.
This episode is brought to you by Alibaba.com, the world's leading B2B e-commerce marketplace. They'll help your business stay competitive and discover new, innovative, and affordable products from over 200,000 suppliers and manufacturers worldwide. And with their trade assurance, you can shop with peace of mind. No more worrying about international payments, delayed shipments, and convoluted refund policies. Even customized orders receive protection. The world of business is waiting for you. Visit Alibaba.com.
This episode is brought to you by Huel. Between hitting work deadlines and exercising, eating healthy food feels difficult. Thankfully, Huel Black Edition has your back. Each 400-calorie meal contains a scientifically calibrated mix of 40 grams of premium plant protein, carbs, fats, fiber, and 27 essential vitamins and minerals. It comes in 9 flavors and costs $2.50 per meal. All you have to do is shake. To get a free t-shirt and shaker and free delivery, go to Huel.com/US.
I thought Chris made a very compelling argument here about why he doesn't want to fund his retirement with stock dividends. I've heard many other reasons to not do it, but his specific reason was simply regarding the return. By investing in companies that reinvest in growing the business versus paying a dividend, you're more likely to get a better long-term return through selling shares. He makes a great point here, and that it might seem like a good deal, but sacrificing growth for income now might affect your income over the long run. From what I've seen, many buy and hold investors don't prefer dividend-focused investments because it's more beneficial to control income for tax purposes when you're drawing down on a portfolio. When you receive a dividend, you have no control over the size or timing of the payment, and 100% of the money received is considered income. Retirees are reevaluating their drawdown strategy year to year based on what the market's doing, any changes in their circumstances or spending, and if they stumble upon other sources of unexpected income. So it's highly beneficial to have a lot more control over how much income is coming from your investment portfolio year to year. Some years you may sell off more, some years less, or you may decide not to sell at all and cover your income needs from other sources. A portfolio built on dividend income doesn't allow this kind of strategic planning year to year So in addition to a suboptimal return, you could be pushing yourself into higher tax brackets unintentionally. And that's a wrap for another Monday show. Have a great rest of your day and start to your week. And I'll be back tomorrow where your optimal life awaits.